Hi, welcome back to Academic Market Insights. As part of our continued series about personal finance, we're going to talk about, or Dr. A mostly is going to talk about a topic that I hope all of you get to deal with at some point, which is employee ownership of the company that you work at or being awarded stock options as part of your compensation and as a bonus for being an employee. And recently, Oracle had really good earnings.
Mhm.
And when Oracle had really good earnings, the owner of Oracle, his share or his personal net worth, Steve Ellison, went up more than where Elon Musk is right now. So Elon Musk got knocked out of being the richest guy in the world, at least but for a short period of time. But when you hear of Warren Buffett or Ellison or any of those guys and their personal net worths, it is usually 90-95% in the firm that they're associated with.
Right.
It shares in and there are a lot of issues that can go along with a big portion of your net worth being associated with the company you work at and the company you own. So with all of that, because I'm starting to jump ahead, I'm gonna let Dr. A get to it and talk.
Well, before we jump into the deck, this conversation is really also made me think about the agency theory. So when we think about these huge compensation through stock ownership, the reason why these people are paid is to align their goals with shareholders' goals.
Mm.
So if they're doing something that is good for them, and it's also simultaneously good for shareholders, and this helps align any issues or eliminates any conflict of interest between a manager and a shareholder. So yes, these individuals have substantial wealth and
Mhm.
it is tied to the company. It is actually good for shareholders that their interests are aligned. Just a quick caveat on that. Okay, now we're going to get into our deck for today. So we'll start from the beginning. Employee stock bonus plans and employee stock ownership plans. So these are similar to stock bonus plans and profit sharing plans. There's going to be some advantages, though, to the employee stock plans. And then we'll also discuss some of those profit of or potential conflicts of interest. Then this is going to be where some of the potential conflicts come from, just things like we were talking about with these CEOs who have a large portion of their compensation tied to the brand itself. So a stock bonus plan is going to be similar to profit sharing plans. It's not necessarily going to be dependent on profits. So you would be potentially paid out these bonuses with or without the company doing well or not doing well. And then the compensation is in the form of a stock as opposed to in the form of a cash. So again, similar to the ownership or the stock bonus plan, it's going to invest this time around primarily in qualifying employer securities. And we've discussed in pensions in the past where there are limitations for how much you can invest in a qualifying employer security, and that's to help eliminate these conflicts of interest. In this type of plan, it's quite the difference. You are looking to proactively put a portion or a substantial amount of money into these different types of securities. Okay, uh, there's different aspects of it. And I want to make the comment, it's participants have the pass-through voting rights. Okay, so when we think about owning the shares, you're going to have a, a form of being able to vote. And I'm going to deviate quite based on our introduction. When we think about some of these CEOs, the way a company
Mhm.
is structured, and I'm actually going to draw this out, you have your board of directors. Okay. Now, You also then have your CEO that reports to the board of directors. So, Dr. Rowe, who does the board of directors report to?
The shareholders.
Yay, shareholders. Now,
And and now you've got a bunch of employees that are shareholders.
right.
And
And
and I have been in this situation twice in my career, and both times we were given some instructions on how to vote our proxies.
right. And we can see how that can become a conflict of interest
Mhm.
very quickly. And if you're CEO and you have a substantial holding then in the shares, you might be able to control more of the board just by your shares alone. And so it's an important aspect to think about when we think about voting rights. And it's something that's not necessarily discussed in depth in a corporate finance class, but it really is an important issue, particularly when we start to think about an individual accumulating quite a bit of number of shares. In fact, this type of investing, that accumulation of shares, this became I want to say in the 2010s, was a popular hedge fund strategy, maybe the 2000s,
Mhm.
where the hedge funds would buy enough shares so that they could vote in people on the board. And then if they voted people on the board, they could then make management decisions because the CEO and the other C-suite members then reported up to the board. So
Mhm.
it's an interesting strategy to get in there and start making decisions. So understanding voting rights is actually very important when we think about these plans. So we do have some diversifications. The we think about an employee, they have immediate rights to diversify versus your employer. There's no requirements for diversification if the employee has less than 3 years service.
Oh.
Conversely, if they have more than 3 years service, then they have immediate rights to diversify. And I thought this was really interesting, Dr. Rowe.
Mhm.
Both stock bonus plans and the employee stock ownership plans are required to provide employees with put options. So I have to ask you, Dr. Rowe, what is a put option?
A put option is a weapon of mass financial destruction.
Sorry.
That's not what you expected me to say.
It
No,
is
and
not.
that's completely untrue. Now, a put option is the right to sell an asset at a certain price pretty much any time between the moment that you buy it and expiration of that option. Now, there are all kinds of things that can change around that, but the basic stock option and the basic way to think of a put option is the right to sell something. And it would be something that increases in value, as you can see on the payoff diagram that's being drawn here. It increases its value as the price of an asset goes lower. So the put option would provide a floor on the amount of assets that you would have if we have some sort of excess volatility in the financial markets.
And these put options are required as a form of safety or protection for the employee itself.
Mhm.
So if the company starts to fall apart and starts to lose a substantial amount of money, your retirement isn't necessarily going to fall apart in
Mhm.
overall. So forcing put options is actually a very good thing for these types of plans, especially if you're not that familiar with how to liquidate a option if you've been given a bunch of call options per se or
Mhm.
anything like that. So fun facts about ESOPs. Uh, 6,500 plans with 14 million participants. It's bigger than I was personally expecting. Controls 2.1 trillion assets, mostly for privately held firms, which is not surprising, but
Mhm.
most 65% were S corporations. And 56% were privately or were leveraged. And I don't have the statistics here, but it's weirdly almost equal across industries. So if you're thinking, oh, it's just in, I don't know, manufacturing, whatever industry, it's actually uniform, fairly uniform across all industries that these ESOPs operate. And again, I was surprised at just the sheer amount of assets that we're talking about, the number of participants, and the number of plans. So practical uses. And these are some of the rules. So like an ESOP must own at least 30% of the corporation's stock, which I thought was surprising. So it's not a controlling interest, but it's a substantial interest. They must, and I love this, must be sold as common or convertible preferred stock.
Hmm.
I know. So I'll put you on the spot. Could you describe a convertible for preferred stock?
Absolutely. And basically, convertible preferred would likely be an equity-like security that pays you the same dividend every year.
Mm.
Dividend's not necessarily an obligation of the company, but as long as things are going well, you would receive those dividends. You would receive those dividends before common shareholders as well. And at some point, you might be allowed to convert your shares into common shares. Mr. Buffett loves when companies need capital infusions. He would often request a convertible preferred exposure. That way, he would get consistent income, and if the stock ended up moving up to the upside, he could convert it at some point. So, it's a desirable method. It's not like the company's trying to do something that's a little bit esoteric and you're not 100% sure why. It actually works in your benefit if to have a convertible preferred security.
Yeah, again, when putting this stuff together, I was just floored by some of these statistics and some of
Mhm.
these uses. Again, 30% is not a controlling interest, but it's still a substantial interest. And I
Mhm.
love convertible. That's why I picked those two. I just thought they were just really great.
Mhm.
So, what are qualified replacement securities? Stocks, bonds, debentures, warrants. So, I'm going to put you on the spot. Can you tell us a little bit about our debentures? And I don't think I'm saying that right.
No, you're saying it correctly. I mean, a debenture is basically a debt security that it doesn't have any assets backing it. It's like a subversion of a bond where company will promise to make some sort of payments in the future, but it's not like in a bond like manner. But also, the biggest difference between a debenture and a bond is many bonds have some sort of assets backing them, whereas debentures do not. And so that's the big difference between those two.
And warrants, correct me if I'm wrong, are these going to be it's again, a fixed income security, but you're going to be looking at different aspects where there are specific rules around the bond. So for example, am I going down the
Well,
right path?
a warrant can represent a lot of things. It typically is the most common form of a warrant might be the right to buy shares at some price in the future.
Mm,
If you hear somebody being awarded stock options, like Steve Jobs was awarded stock options and never took a salary, he was actually receiving warrants. And when a company gives you warrants and you exercise them, they create shares. Whereas if you buy an option from, at SIBO or one of the other exchanges and you convert it into ownership of the stock, that stock would come from another owner that's out there in the public market already.
right.
And then there are also warrant markets that go beyond this. They're very different parts of the world trade differently than we do. And the structured outcomes are very popular in the APAC region.
Hmm.
And there are banks that will issue warrants based on stocks. There's a whole it's like an over the counter option market where they issue warrants based on different stocks over there.
I
So
gotta say, that's just cool. It's kind of neat.
yeah, it's basically an over the counter method of creating options.
Excellent. And again, these are just different types of securities that are going to be rate related directly to the company that can be issued. So
Mhm.
when we initially think about these plans, our first thought is going to be those stocks, but there are other securities that can be issued. Now, there are some advantages and disadvantages. Um, let's talk a little bit about some of the advantages. It's nice because you might not necessarily have to recognize that capital gain if you don't sell the asset, so you can choose when you're going to hit the taxation of it.
Mhm.
For a private company, and remember we said, what's it, 65% of companies that utilize these are privately held. We've created a market, a secondary market almost, so that these securities could be traded. So when you think about a publicly traded company, if you're offered a stock option or have ownership, there is a secondary market which you can go out and sell it, and you should be able to get a fairly liquid price that's going to
Mhm.
be accurate and reflecting the true valuation or the valuation of future cash flows. Um, there's also nice because an advantage to the employee is that you're able to actually borrow against that stock. It can be used as collateral, like for a loan. Um, and it's interesting that an advantage is it could improve cash flow of the firm while simultaneously potentially straining cash flows to the firm. And it's interesting when we think about how that cash flow works and how when we think about the conversion of some of these securities, particularly if we're looking at some of those warrants or convertibles, that could have an impact on that cash flow. And that cash flow, if you're not anticipating your employee to translate the security into cash, then you might have a situation where it's just unexpected and you might then have not properly planned for it. Um, I also thought that it was interesting that it dilutes ownership because, again, it's getting back to your point about the warrants, as you're
Mhm.
creating more of these shares, as each share is created, it does dilute the overall percentage of ownership. And then because a lot of these are going to be privately held firms, there could be a personal liability for some of these officers. So that is definitely a major
Mhm.
disadvantage for employers. Um, and now for the employees, some of the advantage is additional compensation, good tax treatment. Some of the disadvantages that the risk is if there could be insolvency for the firm. Um, and this is, I thought, interesting because there's no secondary market for some of these places. Your valuation is dependent on that stock appraiser. And I don't know if you've had this experience with house appraisers, but they can run the range for valuations.
Mhm.
And we would like to say that in this industry, everything's consistent, but this is a very subjective field where we could have situations where valuation isn't accurate. And then we also have liquidity
Mhm.
issues, right? If you don't have a big enough pool for that secondary market, you're not going to be able to really have a fair value then. Diversification issues are going to be with who is a qualified participant. You need at least 10 years service and at least 55 years old. Qualified election period is a 6-year period beginning with the first year of the plan. So these are plans are not geared for employees that are temporary. These are employees who are going to be with the companies for quite a long time. As
Mhm.
corporations, you need to have no more than 100 shareholders. Uh, they must be individuals. So these individuals or these shareholders can't be financial entities coming in. And there must only be one type of stock. So no preferred stock, no distinction between common and preferred.
Mhm.
Disqualified individuals, owners with other family members. If we had a family together and there's 6 of us and we own 20% as a block, this would not be, we would be disqualified. And if you don't have family members and you own 10% or more, then you would also be disqualified. And that concludes our discussion on
Snuck up on us.
it did, employee stock ownership plans. We hope you've enjoyed us. If you did, please hit like. If you haven't already, please subscribe. I just thought these were really fascinating. Again, especially with some of the requirements of having put options, who's participating in these, and some of the agency theory issues. Thank you so much.